Dave Ramsey is a financial expert who is dedicated to helping people build wealth. He has provided a lot of different financial tips for saving more and avoiding credit card debt. But one simple piece of advice could make a huge difference in whether you end up rich. In fact, it claimed that if you follow this suggestion, you could potentially end up a multimillionaire. Let's find out how. Make sure you watch till the end. Dave Ramsey claims that you could easily end up rich. How so? According to Ramsey, there's a really easy formula to end up a multimillionaire that almost anyone can put into place. It involves changing the way you buy a car. Ramsey explained that always having a car payment cycle is holding people back from really moving forward with their money. He believes that if you avoid car loans and instead save up to pay cash for a car, you can invest the extra money and end up rich. This isn't just a hypothesis either, as he actually provided some hard numbers. Specifically, Ramsey pointed out that the average car payment on a new car is $577, and that new cars lose 60% of their value over the course of the first 5 years. And he demonstrated exactly what could happen if you skipped out on taking out that big car loan. According to the solution he offered in Ramsey's Solutions blog, he pointed out that, let's say that at 21, instead of taking out a car loan, you invested that $577 every month. At an annual return of 11%, you would have $9,630,619 when you retire at the age of 67. Personally, I couldn't agree less with him on this. He further explained that if you end up with close to $10 million, which is indeed a reasonable amount to expect if you save $577 per month for several decades, then you would be quite rich indeed, all because you didn't borrow for a vehicle. Is Ramsey's claim valid? Should you listen to him? Ramsey is absolutely right that taking out a car loan could cost you a lot more money than you realize once you factor in the lost gains that you passed up by borrowing for an asset that loses value, instead of investing in assets that produce a generous rate of return. Of course, his math overlooks the fact that you probably need to have some kind of car. He suggests saving up and paying cash for it, which is a smart move. However, you'd need to use some of your money to do that, so you wouldn't necessarily end up with an extra $577 every month for your entire career if you took Ramsey's recommended approach, since some of the money you save on your car payment would need to be diverted to actually buying a used vehicle with cash. Still, it is absolutely possible to end up a lot richer if you avoid borrowing to buy new cars. As published in an article a few years ago, if you save up for reliable used cars and invest the difference between what you would pay for a used car versus a new one, you could easily and realistically find yourself with a lot more money. Yes, it is very much achievable. That is to say, whether you end up a multi-millionaire will depend on just how much you can cut off your car costs by paying cash and buying used. If you can drive your cars for a long time and pay little money for them, you can save most or all of that $577 a month and get close to Ramsey's numbers. It's absolutely worth the effort. Next up, let's look into another Dave Ramsey claim that says you could be up a creek if you don't have some kind of insurance coverage. What insurance coverage is he referring to here? Keep watching to find out. Buying the right auto insurance coverage can provide important protection for motorists. Finance expert Dave Ramsey has recommended buying many kinds of car insurance, including required liability coverage and optional collision and comprehensive insurance. But Ramsey recently mentioned another type of protection in his recent publication that he said many drivers need to have to avoid financial disaster. I know you're very eager to know the type of insurance coverage that's up for grabs here. Okay, we're talking about gap insurance. Haven't you heard of it? No worries. I will do well to explain what there's to know about gap insurance. Here we go. According to Ramsey's publications on his blog, gap insurance is designed to cover the gap between the car's actual cash value, including depreciation, and what you still owe. A cool form of insurance, right? Keep watching, there's more. Ramsey recommended that anyone who finances or leases a car should purchase this coverage. Otherwise, he explained that if, as a driver, you fail to put this protection in place, you can be up a creek if your car is totaled and you're stuck making payments on a car you don't even have anymore. Here's why I think Ramsey is right about gap insurance. Ramsey is correct that people who finance or lease vehicles should have gap insurance. That's because there's a big chance that if a car is totaled, insurance won't pay enough to cover the outstanding car loan in full. You see, many people who purchase or lease vehicles make small down payments and then repay their loan over a long period of time, often several years, and vehicles can go down in value quickly. So shortly after a motorist drives off the lot, the car may be worth less than the driver paid for it, especially if the vehicle is brand new. Remember that that if a car is totaled, the insurance company pays the depreciated value of the vehicle. The depreciated value paid for the car is the current market value of the car, which may not be very high if the vehicle is a few years old. If a driver owes more money on a car loan than insurance pays after a car is destroyed, this doesn't absolve the driver of responsibility for repaying the loan. On the other hand, when a motorist has gap insurance, the gap insurance policy will pay off the remaining loan balance. Say, for example, a driver owes $20,000 on a car and receives a check for $15,000. Gap insurance could pay off the outstanding balance on the loan above and beyond the money insurance provides. But without gap insurance, the driver would still be responsible for paying the remaining money due on the loan. This could mean paying thousands to a lender for a destroyed vehicle, which no one wants to do. Once motorists understand what gap insurance is and why it's needed, it's easy to see why Ramsey believes being without it could lead to dire consequences. What's more, many lenders and leasing companies actually require gap insurance, but even motorists who are not mandated to buy this protection may want to explore their options for adding it to their insurance policy to protect their financial future. How much car insurance do you need? When selecting an auto insurance policy, drivers need to look for more than just the cheapest car insurance. They need enough coverage to ensure an accident doesn't cost thousands of dollars, which may require paying a higher monthly premium. How much car insurance coverage a person needs depends on their situation. However, most states have certain minimum requirements. Drivers may also wish to purchase additional protection beyond the minimum coverage required under their state's auto insurance rules. Let's now highlight some different kinds of auto insurance drivers may need or want to buy. Let's start with personal injury protection. Personal injury protection, or PIP, pays for the policyholder's medical bills and lost wages in cases of minor accidents, regardless of who is at fault for the crash. A total of 15 states require PIP. These are called no-fault states. People who live in no-fault states must use their own insurance to pay for losses after minor accidents. That's true even if another driver were to blame. New York is an example of a no-fault state. It requires drivers to buy at least $50,000 in PIP coverage when purchasing New York auto insurance. Next up, liability insurance. Liability insurance covers losses that the policyholder causes other people to experience. For example, if a driver caused a crash, injuring the victim and damaging their vehicle, liability coverage would pay for the victim's injuries and damages. The majority of states require liability insurance coverage, both to pay for bodily injury and property damage. Another important insurance coverage is collision insurance. Collision insurance is optional, but it is important coverage many people will want to purchase. Remember, liability insurance won't cover anything that happens to the policyholder's own car. Even with the best policy, a driver could buy collision insurance to repair or replace their vehicle in the event of a crash. Wrapping it up, we have comprehensive coverage. Comprehensive coverage is also optional, but many drivers will find they need it. It pays for any losses to a vehicle that don't result from a car crash. For example, comprehensive coverage pays for windshield damage or to repair or replace a vehicle after a tree falls on it. That concludes today's video. If you found the video helpful, please do consider giving us a thumbs up. And don't forget to share the video with your friends and family. See you next time.